Hi, I'm Vanessa Stoykov and welcome to a brand new episode of Wicked Problems, Visionary Investors. This is a show where we bring together world-class investment experts with professional financial advisors to help solve some of the world's biggest wicked problems. Importantly, we ask how the financial services industry can play a role in solving these issues. So let's have a look at today's wicked problem.
Today's wicked problem: how do we foster global investment when everyone looks after themselves first? More than ever, protectionism and politics are dictating global investing. So how do we find the right approach to manage risk in a world of deglobalisation?
How do we access global opportunities when the world is on geopolitical tenterhooks? Joining me to address this problem are Amanda Gillespie, Perpetual's Group Executive, and Lukasz de Pourbaix, the Chief Investment Officer at Lonsec. Welcome, guys. Okay, today's wicked problem, guys, is, at the end of the day, how do we foster global investment and global investment opportunities when everyone looks after themselves first? And I know this sounds, it's human nature. It's not great, but it's real. And, America first was real, and protectionism and deglobalisation are real. So, starting on that big philosophical statement, Amanda, talk to me about it.
Sure. Well, I think overall, I would say that global opportunities haven't gone away, and so we've still, as investors, got access to global opportunities, but they'll look very different in terms of how we invest globally. So if we think about the last decade, we've been in an environment of low interest rates, low inflation, and bumps along the way, but in general rising markets. And now we're in an environment with rising interest rates, rising inflation, geopolitical risk, and it's a very different environment for investors. And what that means is, thinking about your toolkit and how you access investments probably becomes a bit more important than maybe it did in the decade prior to the pandemic.
Well, there's no doubting it. I mean, you pick up every paper device and it's all interest rates are up, house prices are plummeting or will, and it's a different place than it was even 2 years ago, a very different place. Lukasz, talk to me about inflation. Everyone's looking at it. It seems to be one of the big things on the agenda. Where do you think it's going?
The inflationary environment at the moment is really just a symptom of a period of transition. We've had 10 years of record low interest rates, 10 years of central banks really supporting markets via unconventional monetary policy. And arguably we're getting back to a more normal environment. Now that means that we're seeing more inflation, interest rates are going up. So I would sort of argue that it's a period of transition. A period of transition is sometimes painful, which we're, more volatility, resetting of where markets, how they're priced. But it does mean I think there's going to be other different investment opportunities from maybe what there was over the last 10 years. So it's not necessarily something to be scared of, but it is something to consider and think of, okay, what does this mean for portfolios going forward? And do I have to think about those things a little bit differently?
Okay. And what sort of questions are you fielding from advisors around, we've entered a transition period, so, what are they asking? What are clients asking them that they're asking you?
Yeah. Well, I think this environment has been really interesting because there's been nowhere to hide, really. So whether you've been in equities, whether you've been in bonds, the classic 60-40 type balanced portfolio hasn't really done what it's meant to do, which can happen in these sort of periods. So the question is, a lot of the questions we tend to be getting is just reassurance, and I guess more forward-looking. So, okay, we've experienced this volatility, clients have experienced some pain. What do I have to think about looking forward? Because the worst thing you can do in such environments is just to be reactive and make decisions based on the news cycle, so to speak. So it's just about providing a bit of comfort around what's happening, but where the opportunities may be in the future.
And Amanda, what's Perpetual working on? I mean, you guys are a shop that has international funds and a long history. What is your view of what's going on?
Well, I think as Lukasz said, you can't predict. I mean, it's difficult to predict what the future is going to look like. I think what we do know is it's going to be different, and so it's having those conversations about it is uncertain. So think about kind of future proofing how you invest. From Perpetual's perspective, on the equity side, it's I do think for active management and bottom up equity investors more generally, it does present lots of opportunities, because it is important to be thinking about each investment you make and how is that investment positioned to weather the storm of inflation or rising interest rates. So I do think it is an environment that supports bottom up stock picking. I think more broadly for advisors too, I would be saying think about the role of, which both play a role, but active and passive in your portfolios, because in an uncertain, volatile environment, active management can shine or become more valuable. So it's those kind of things that we're kind of talking about. The other thing I would say is looking at investments that can actually benefit, that have pricing power, can actually benefit from rising inflation. So it's those kind of conversations.
Okay, so give me an example of that. What's something this pricing power that could benefit?
Yeah, so I suppose companies that are in an industry where they have, that they're a monopoly or not, have a lot of kind of, strong position in that industry. They control their input costs, so they've, got more ability to control their margins. And so it's looking at that kind of, how the business is structured. Another example, which I know we're going to get onto in a little bit, is, companies that have been reliant on supply from offshore that are able to shift their supply to onshore, okay, are obviously better positioned.
And that sort of protectionism is a word, but it's almost good news, Lukasz. So talk to me about this opportunity of companies to bring workforces back home, soil, things being here. I mean, it feels like a good thing, right? I mean,
yeah, it's a double-edged sword. So I think from on one perspective, the last couple of years of COVID have really sort of brought supply chains. Everyone's talking about supply chains today.
Yeah, I even get it.
Exactly,
I get the supply chain dilemma.
Exactly.
So.
But look, it's really taught a lot of businesses around the world that you need to be diversified in your supply chains, not be sort of concentrated on one part of the world. And as we've seen the last couple of years, you can't even get a pair of shoes or something because they don't have materials or whatever it is. So you are seeing companies diversify. Not only onshore, but to other jurisdictions around the world to have more fluidity in those supply chains. We are seeing some evidence of some onshoring, both here but also in the United States. I think the interesting thing about that is if you do see that trend continuing, it's likely to put inflationary pressure on prices as well. So because the cost of, say, making something here in Australia is far more expensive
higher,
than somewhere else, for example. So
that means we have to accept we're paying more for things.
Correct, absolutely.
Get more
and do
certainty.
you believe we should be saying that to people as now? Yes, everyone's talking cost of living, but this is not going to change in any time soon.
Well, I think companies will adapt. I think Lukasz is right. It does mean you might have more certainty, but you perhaps lose some efficiency, and there's more cost, arguably, in moving to onshore. So we'll probably find that we meet some equilibrium somewhere in between, perhaps. Yeah.
But just on that, it's interesting because if you look at what companies have done, is there's been a lot of countries that have benefited. So if you think about China, then sort of the countries near China have benefited. So there's been a lot of companies, for example, go to the Philippines or wherever it may be.
Okay.
So it's really a story of diversification, which sort of makes sense when you think about it. But everyone was hooked on this sort of one
way of doing things. Yeah, that's interesting. And Amanda said to me, we were talking beforehand about this whole session, and Amanda's key word was diversification. It's what advisors and investors and everyone's thinking now. It's spread your risk, I guess, spread your risk. And talk to me, in a perfect world, what is a good split? What would you be looking at now? And back in the day, it was sort of 30-30, a bit of a more bias to home, and then the rest global and infrastructure and all the rest. Has that changed? Has asset allocation changed from a Perpetual perspective, at least?
Yeah, I mean, I would say that it probably depends on your investment objectives and where you are and your, are you accumulation or closer to retirement as to what that mix of growth and defensive assets look like. From a Perpetual perspective, we have some multi-asset products that don't have a set mix, so they will kind of tilt and move around. And I suppose to my point earlier, I think it's thinking about being nimble at the moment because the environment's changing and it is volatile. It's having kind of access to investments that can be nimble. Would probably be my answer, but I know Lucas has probably got, obviously from a Lonsec perspective, some asset allocation positioning as views.
You've been talking about active choices, actively investing, and I read the other day, as the world reads, Scott Pape, who has a new book out, but he was in his article saying, look, Vanguard's coming to Australia and everyone who's got super should really consider a low-cost index fund for their super. And I thought, my thoughts aside, do you think that people who are in index funds going into this period of transition, to Amanda's point, are going to miss out on returns?
I think it's a challenging one because, again, if you look at the last 10 years, it's been a very easy trade because you've had basically equities, everything go up, the good, the bad, and the ugly, right? So going index,
all boats
absolutely,
rise.
Yeah. So going index has worked really well. What I'll sort of say is that it's not a binary answer. It's not like now it's index or then it was index, now it's active. I think it can be a bit of both. But I would say that you would certainly think that in an environment where there is more dispersion there's a bigger dispersion between the good and the bad, that does create opportunity for active managers, and we haven't had that type of environment for some time. So even when we've looked at say companies on a company level over the several years ago, you'd have great businesses, but they were trading at really high prices. So that's really challenging. But now, because you are seeing dispersion, you can get some really good businesses that have just been carted out because everything's been carted out. So,
so bargain in values back of finding
not even
the
value.
bargains?
I think even there's growth names as well. I think it's across the full spectrum. So if you think about the tech sector and it's on the nose at the moment. Interest rates going high and all those growth. A lot of those growth stocks have been carted out. But then you look within that sector. Yes, you've got the sort of startup with no earnings. A whole lot of debt, they're probably gone. But then on the other side, you've got tech companies that are doing really well, strong earnings, and if anything, they're probably going to get stronger. So it's not. I think it's more nuanced, but it is a bit of a clean out, this type of environment.
And I think that point that Lucas makes around companies that have kind of got quality characteristics in terms of good balance sheets, not too much debt, given the to withstand rising interest rates, and probably can demonstrate earnings in an environment where there is a lot of pressure on growth, and also I suppose we would say good to kind of look at experienced management teams as well that can kind of navigate through the minefield that we're in.
And have you found it easier because the world's taken off with Zoom and phone to access management teams and things in this sort of post-pandemic world? Has it been an easier thing?
Yeah, I mean, absolutely. I think that the ability to have Zoom meetings both with work colleagues and clients and companies is
brilliant.
It's definitely made that opened that communication line up, and that's been fantastic. I think that's one of the good things, if you could say there was anything out of the pandemic. But there's probably no substitute for sitting and face to face and really kind of reading the body language of someone and seeing the on site and seeing the operations. But I think there's a role for both.
Okay, it always sounds a bit glamorous, like Indiana Jones type, going and nutting out what they're like and figuring out if they're telling the truth or not, but I'm sure it isn't as glamorous in the real world. But I'm still picturing it that way. Lukasz, let's get a bit philosophical now. Let's bring out your economics background. In a world of deglobalization, where do you see it going? When America first, China trying to expand reach, everything, and I'm asking you to be a little bit of a Nostradamus, I won't hold it to you, but the world seems precarious, and where do you see it playing out?
Yeah, look, I think, obviously the geopolitical situation at the moment is, the war in Ukraine, tensions in China, all of those things are sort of at the fore at the moment. And there can be that tendency to look inward and everyone put up their sort of...
put up the fence, so to speak, build the fence, yeah,
fences
okay.
and so forth. But the reality is, take China, for example, a very fast-growing economy, a big transition of wealth in terms of growing middle class and so forth. They need to be global, right? They need to generate a certain level of GDP growth, basically to keep stability within their country. Okay, so I think the notion that someone like China or America or anyone could just sort of say we're stopped, business is stopped, it's just not a reality.
Okay.
So you might see, obviously, and look, the geopolitical tensions aren't going to go away, and I think there's they flare up every so often, but unless we think we're heading into sort of Armageddon type of scenario, which I don't think is the base case, countries will still
If
trade.
we do, I'll call you and go,
Yeah,
well,
I was wrong.
you got it wrong, Betty.
I was wrong.
Going down.
I was wrong.
Okay. And what's, again, philosophy-wise, you're almost saying it's impossible to totally close fences and deglobalize to the point where we're all our own island. How fast do you think it's going to happen, and how much more? Just your thoughts?
Personally, we've obviously already seen it happening, and some of that maybe is here to stay. But I think there'll be, I just think competition will mean that people will be forced to kind of look at opportunities to kind of move back globally as well in terms of how they run their businesses. So I don't know the answer full stop, but I think it'll be somewhere. I think there's going to be a bit of both. How quickly we move back to a more global perspective and what that looks like, I'm not sure.
Okay. And in the spirit of now we're diversifying because everything is so different, what are the things people that you both see, actually? I'll ask you first, Lukasz, and then come back, that our investors are diversifying to, and advisors are advising clients to look at now that perhaps they weren't in a
Yeah, well, I think
market.
The interesting one, probably the one thing I'd pick out is bonds. So, for the last sort of 10 years or so, the consensus view is they're not really investable, low yields.
They're not that sexy. Yeah.
They're not that sexy.
But you're telling me they are sexy now.
Well, they maybe not never be sexy, but but I guess, and to my sort of earlier point around, when there's shift and transition, it creates other opportunities. And I think, for the first time in a long time, certainly that's one part of the market we're getting a lot of questions about, just because of the volatility, but also a lot more interest in terms of, okay, things have changed. Bond yields are not at zero anymore. 3 to 4%, whatever it depends on the jurisdiction. But that starts looking interesting. If we're going to have a lower return environment, maybe going forward, 4 to 5%, whatever it may be, it starts looking a bit better than zero, right? So I think it's not sort of. I sort of think about it as going back to the old, in a way. The last sort of 10 years has been gung-ho, risk assets, doesn't matter what asset, anything with risk, it just went up. Now it's it is going to be more of a balancing act. It's not just going to be, let's go all risk assets. It's going to be, I need a bit of this in my portfolio as well. I might need maybe some alternative assets as well. And that's an interesting one as well, in that, again, in a bull market, no one wants alternative assets, because why would you go there? Now we're starting to see a lot more interest from advisors around alternative assets, because when the world's uncertain and there is more dispersion in returns, well, maybe there's a place for that type of exposure.
What's your thoughts?
I would echo that as well. I think there is, and you're right, like alternatives and even investments that have more of an absolute objective as opposed to, outperforming a market benchmark. When equity markets are running hard, they tend to probably lag a bit, absolute return type products. And so I think we are seeing more interest in that type of product. And I think to Lucas's point, it's about, I think advisors are thinking about, well, how do I get some inflation protection into my portfolio, or, some inflation hedge? How do I get some downside protection if things go really badly? And how do I also have something in case actually the central banks get it right and, we're back on a growth trajectory. So I know it feels basic to say it, but it is about probably having some diversification and thinking about those different elements.
When I started my career way back when, I worked for Zurich Insurance, and we used to go out and talk about PSTs, balanced superannuation trusts, and educate on that balance makeup. And I see the whole back to the future again on it. It feels like we are coming into the time where those sort of things might be more interesting to people, blended products. And okay. So that's it for this episode. Thank you to our guests, Amanda Gillespie and Lukasz de Pourbaix. Very interesting conversation, and thanks to you for joining us on this episode of Wicked Problems, Visionary Investors. Next week, we hear from our live studio audience of advisors to find out how they're tackling client demands for access to global investment opportunities. I'm Vanessa Stoykov, and thanks for watching.
Okay.